Hey, everybody, welcome back to the Four Star Podcast. I'm here, Brian Kasal. I'm your host, and I'm here with the esteemed Mr. Christopher Reardon. Chris, welcome to the podcast.
Thanks, Brian. Good afternoon, and good afternoon to everyone out there.
And longtime podcast listeners know that Chris is our four-star director of development. He's the master of all things portfolio, marketing, trading, reports. And of course, Chris still loves his Cleveland Indians and caretaker of his golden doodle puppy, Hudson. And he's got a new Reardon with him as well this year. So that's a new addition. Again, Chris, we're proud you're with me here. My good friend, Chris, on the podcast.
Thanks again, Brian.
And I'm the founder, Brian Kasal, the CEO and founder of Four Star Wealth. I'm an Eagle Scout, a trustee of the National Boy Scout Foundation, philanthropic advisor to CEOs and insiders, chief dad to Quinn and Evan, and husband to the amazing Tripty. And I would ask all of you, if you would, please give us a 5 out of 5 if you like what you're hearing. We're going to start today with our regular program about the markets, the economy, and then what you see in general out there in the world. And Chris, big changes between the relationships in the markets, and it's signaling things. Let's get into it.
Yeah. So, like you said, Brian, a lot of changes. Some of it's a continuation of the trends we've seen over the last couple podcasts, but really starting almost at a tipping point. Number one is still domestic equities, and but it's lost 14 points since the last podcast and now sits at 284. What's significant about that is it's only now 1 point above the number 2 asset class, which is commodities. So commodities is sitting at 283, and it's gained 4 points since the last podcast, so gained slightly there. But really in that number 1 and 2 position, if trends continue, we would expect to see commodities overtake domestic equities, at least in the near term, in that number 1 position. International equities still sits at number 3. It's been relatively stagnant. It did gain 1 point since the last podcast, and it sits at 210. So still far, there's still a significant amount of difference between international equities in the number 3 position and commodities or domestic equities really in the 1 and 2. Fixed income still holds the number 4 position. It gained 5 points, so it did gain a little bit. It's at 138. Cash held steady at 109 in the 5th position, and currencies in the 6th position gained 6 points. So the biggest gainer since the last podcast, and it sits at 64 tally points. So a bit of movement there. Obviously, I think the biggest impact really is the pullback of domestic equities, and how close it is now to moving into that number 2 position.
So it is interesting. The last time we saw commodities right at the door of the number 1 position was in 2015, just for a couple of months. And then the last time we saw a real strong commodity market was in 2010. And that was right at coming out of the recession, or kind of maybe still partly in the middle of it, because the real estate markets didn't bottom until 2012. We're looking at this, Chris, with kind of an eye toward why there's really high volatility. Markets are really open this year in January with a thud. We're down about 6% in the broader markets, a little less in the dividend stocks, a lot more in some cases in the growth stocks. The tech stocks have been slaughtered, and we've had big high volatility, as well as the small companies have been really routinely taken out back and shot through the head. Really difficult market here. So that's what we're seeing here, Chris.
Yeah. I mean, I think it makes sense a little bit. I mean, commodities have definitely, we've talked about it on here, commodities have definitely seen a little bit of a surge due to supply demand issues. I think you have geopolitical issues with Russia and Ukraine putting pressure on the price of oil and gas. So there's a lot of things at play that are causing pressures from the commodities front, and likewise, there's a lot of things in the U.S. With the potential rate rises coming down the line, and other aspects that are putting some pressure on the downward side. So you just really have a convergence there, and whether it's bad or whether we're entering a recession or going towards a recession, we don't really know, but we just see a little bit of, I would say, increased volatility in the short term.
For sure. And maybe the commodity move really doesn't have much to do with going into a recession necessarily, and inflation. It could be just simply the supply and the lack of the ability to produce some of the commodities that are out there too. We saw prices going up because we had basically demand push, and there wasn't much demand. There was a lot of demand, but there wasn't much product out there. Car prices went up. A lot of other things went up in price, and inflation. And the same thing could be true for these commodities. So we've never really recovered from an economy like the pandemic economy, because we've never had an economy like the pandemic economy. The last pandemic we went through in America was in 1918, and we didn't have financial markets that were as organized and broadly based as we are now. So this is a new experience. Some people try to say this time is different, and other people say, no, this time isn't different. But there are certainly some elements of the economy that are different this time. And so we're trying to make sense of all of it. We see headwinds, and we see really strong growth in certain areas too. So we're trying to, again, try to make sense of it. But we are seeing some high volatility. The destruction in technology stocks continues with Facebook, and now the firm is called Meta, down 26% last week, and a brutal month for tech. The firm is betting on virtual reality headsets and alternate reality glasses. I think they spent $3 billion on it last year. So they're trying to pivot from only being a Facebook company to getting involved in all these other different types of technologies that will interface with the Facebook, I believe, as well. So we'll see how that all plays out. But in the short run, it did affect them. And then, Chris, you know the story that Apple did increase some of the controls and compliance controls on usage of Apple by other companies that use Apple's system on their advertising and things like that. And it affected a lot of technology companies, including Facebook Meta. So, it's an interesting time. No one thought it would get that bad, but the stock was down on that Thursday, $30 billion, which is the most of any single company has ever lost in a single day. And Mark Zuckerberg, the founder and CEO, lost $5 billion, I believe, on his own. So it was quite a volatile market. It was kind of a culmination of a lot of other names. Snap went down big that day as well. So it was a really brutal previous Thursday.
Yeah, you saw a lot of the social medias take a big hit, just obviously due to having that relationship. I know another notable statistic that Meta or Facebook reported was they actually saw a decline in Facebook users for the first time. So we're seeing a little bit of a decline there as well. And I think the metaverse is what you're kind of alluding to. And I think Facebook's really made a pivot to try to go in this direction. So far, there's been a lot of expenditure, not a lot of return. Who knows what's going to happen down the line, but as far as right now, it's a little off-putting, I think. They haven't, and that's why the stock got whacked so hard. And I think it is important to point out that Facebook thrives on getting data about people that are on their platform, and then, providing that data to advertisers to help them, whether they want to advertise their products or services. And, I think Apple kind of took a step out there and said, we're not going to provide this if the end user doesn't want to. So some of those restrictions have hurt the advertising revenue, I believe, of Facebook, and that's what's pushed some of the revenue down.
Well, there's some other headwinds out there also, with both political parties in Congress in the United States are concerned about cancel culture. They're concerned about the technology companies using their power to cancel people and take them off Facebook and things like that. So there's investigations that are starting, and that probably will only get worse. So there's some headwinds there for sure. Then ironically, right after we had that horrible Thursday, the stock that had been drifting a little bit, the largest retailer in the world is Amazon, and Amazon stock was up. I think it was about 13 to 15% the next day. And that ended up being the largest single up day of any company in American history. So it was a huge multi-billion-dollar move for Amazon. So Amazon appears to be back on a better trend. But Chris, the brutal nature of the technology market in January and into the first couple of days of February is pretty clear. Peloton stock is down 79%. So there's been a lot of pain out there. When we talk about the economy, Some people are saying, well, it's not really the 70s in some ways. Same ways it's worse than the 70s. In some ways it's not worse than the 70s. But nonetheless, there's a lot of weird things going on in the economy. And it's still just coming back from this pandemic. Again, we've never had a pandemic in the modern economy in America. We've never shut down 40% of our economy entirely. We've never come back from shutting down 40% of our economy entirely. So these are the things that we're seeing, and it's really new stuff. Chris?
Yeah. I mean, and I think with Peloton, it actually shows an interesting trend. So, like you said, it's down about 80%, 79% from its high. And what we're seeing now is a lot of companies kind of circling to see about, acquiring it. I know names have been floated, such as Amazon and Nike, floating at purchasing Peloton now that it's been down. And with a lot of companies have been hoarding cash, keeping cash in reserves in case of a downturn. With the pandemic, a lot of unknowns. Now they're starting to feel a little free. They're going out and doing acquisitions. We talked on the last podcast about Microsoft acquiring video game developer Activision Blizzard. I think it was about a a little under $70 billion transaction there. So, I think companies are looking for other companies and where they can be strategic, find companies that are down, stock prices are down, and come in and acquire them. And I think that's something we're going to continue to see. I know one of the latest trends I saw was with the labor market being tight. And so if you can't find new talent to hire, why not acquire a firm with a very talented team? And that way you kind of bring them underneath you without having to attract them away from their current firm. So I think we're going to continue to see that. We have a lot of these companies have a lot of money in reserves.
Yes. Well, and then we had some interesting jobless claims numbers. It's confusing. Chris, you got the detail.
Yep. So the jobless claims numbers came out for the last week of January, which ended in the 29th. They decreased, so it's positive. They decreased to a seasonally adjusted 238,000. It's a decrease from 261,000. So a slight decrease there. And then I think alluding to what you said, Brian, the U.S. economy added 467,000 jobs in January, which came in well over expectations. But I think the key thing to highlight there is that 467,000 job number was seasonally adjusted. And so what that means is they're taking in certain considerations. They're trying to kind of, if you will, iron out some of the seasonality with certain jobs, things like that. And in reality, the jobs number was flat, if not negative, for January. So there is ways to paint a rosier picture, and potentially what we could see is future job numbers kind of revert back slightly. So I think that a lot of the politics tried to paint a very rosy picture around that, but I think all in, overall, it was I think more underwhelming number than people actually took.
Well, and I think part of the issue is that there are a lot of nuances to some of those numbers and seasonal adjustments, and those are seasonal adjustments from 2021. So that's the last set of adjustments we're going to get for at least another year. So now we're, if it was the normal number, we would have seen probably a down number. So we'll see if that accelerates coming forward from here. But it does appear that the jobs growth is slowing to some extent. And that's what we saw really in this quarter, except for the seasonal adjustments that made up for things that weren't announced last year. So we'll see where it all goes. Consumer spending on services, I believe, was up, Chris, right?
Yeah. So ever since the pandemic struck, I don't think it's been a secret that consumers have been spending on durable goods, whether it's been going out and buying a new TV, home improvement projects. So durable goods spending has, been accelerated, and it really peaked at around a 34% increase during the pandemic. And that slowly kind of tapered back. Meanwhile, services took a big hit. Service spending, travel, going out to restaurants took a big hit, and it's slowly been creeping back. And right now it's negative 0.7% from pre-pandemic levels, which is pretty much back to pre-pandemic levels of spending. And I think a lot of people are projecting with the decrease in cases, a lot of countries opening up, a lot of the lockdowns and mandates kind of easing off, that we could see that go positive and see that accelerate. So we could see almost a kind of a switch where you have less and less durable goods spending and more services spending, and they could kind of swap this year as you have pent up demand to travel and go out to restaurants and spend on all those good services.
So I tend to travel a fair amount, and we've seen a lot of activity in the airports. We're not back to pre-pandemic levels, but we're getting there in certain areas. And then this weekend, just anecdotally, all through Wisconsin, we were touring resorts for some family reasons and saw incredible activity at the resorts in southern Wisconsin, Lake Geneva, Lake Delavan, in those areas. So, and from my experience in recent travel, we've seen lots of conferences are being launched now. Pandemic is getting mostly over. The mandates, the vaccine and mask mandates are being unwound either by courts or by governors directly. So we're seeing a lot of activity that wasn't there before. So maybe we don't go into a recession. Maybe the economy accelerates from here. But Chris, it's really anyone's guess at this point, isn't it?
Yeah, I mean, I think you hit the nail on the head in the beginning. I think that we really haven't seen. We don't know what people to expect, what people are going to do, right? And there definitely is a pent up demand and a want to travel. I guess the unknown is: are people going to feel safe, financially safe enough to spend and go travel? Are they going to hoard that and try to increase their savings? I think from a positive case standpoint, I think the job market is robust. People that have jobs have mostly seen positive raises, which is increasing their wealth. So now I think if a lot of economists have projected out that people will go and spend, and a lot of that will be in the services.
Yes. Well, and for more information on some of these ideas, our economist, four-star economist Bob Barone, writes in Forbes magazine, and he had a very interesting piece about the explanation of that jobs number and why it wasn't as good as it appeared. I mean, it's always good to have a good number. We're not against good numbers, obviously, but it wasn't as good as everybody thought. But for more information on that, refer to Forbes magazine to under Bob Barone. He's the four-star economist. So there's some more information there. Now, Chris, on the other hand, while maybe some of the numbers weren't as positive, we also saw home prices, continuing to stay high, right?
Yep. So the S&P CoreLogic Case-Shiller National Home Price Index, that's a mouthful, but rose 18.8% in November. That's year-over-year numbers. Still very positive. It was slightly down. It was the number it posted year-over-year in October was 19%, but still a very strong housing market we continue to see. I think it's overall positive that it pulled back a little bit, but it still remains, I think, very, very strong, from that standpoint. The U.S. consumer spending is another thing I'll note, that declined 0.6% in December from November. We kind of highlighted and talked about this. I think a lot of that spending was front loaded, because I think you had a lot of holiday shoppers who purchased things in October, even September, because there was a large fear that the scarcity of goods, people wouldn't be able to get what they needed for the holidays. So I think that front loading number did play a little bit of impact on that decline in spending.
Well, and Chris, before we had the pandemic, we were starting to see a recovery in interest rates, meaning interest rates going up, and a normalization of the economy. And then, of course, the pandemic hit and rates went down to rock bottom again. But now we're starting to see rates sneak up a little bit here. And the Fed is claiming they're going to be raising rates. We've heard, threats of 3 and 4 increases, but it could be maybe less than that. One executive said 7 increases. I think that's not possible. But there's enough headwinds in the economy swirling that 1 to 2 rate increases could be possible. But we're already seeing the 10-year Treasury heading up almost toward to 2%, right, Chris?
Yep. Yeah. Closed today, which is February 7th, for those of you listening, closed at 1.92%. So it is really starting to test that 2% level, which, you think 2% is still very low. And I will say the 10-year U.S. Treasury is usually what's correlated to mortgage rates, because the average mortgage is usually held around 10 years. So usually that's what correlates to interest rates the closest. 2% is still very low, but it's more of a psychological thing and an impact on the markets when it hits that 2% level, and it will start to weigh on the market. The higher that number goes, you think about it from a just a general perspective, if you correlate 2% being your risk-free that you can get, you can, hey, without taking almost no risk, you can get 2% return. And some people look at that and they'll take that, whereas maybe 1% they weren't willing to take. So as that inches higher, it'll put a little bit more pressure on people saying, I'm going to pull more money out of the market, and I'm more comfortable with this conservative return, and that's going to pressure up all the other bond yields. So we'll see how that plays out, but that impact is going to have an effect on the markets, especially this year. I know in March, the expectation is a Fed increase. I think the one variable is some people, whether they're going to raise it 25 basis points or 50 basis points, which would be almost raising it twice essentially in March. So there's a little bit of play there on that. I think we'll see that play out as the economic numbers come out, but it's definitely going to impact the markets, and it's going to be a primary driver of the markets this year, I would say.
It could be, and I guess the question that we have to ask ourselves is, should we fear higher interest rates? I know that savers will be happy about it. They'll get more interest. Certainly seniors who have a lot of money in safe bucket, wealth preservation type assets will see higher interest probably on CDs and other bonds and that kind of thing. So that could be a positive for them. But if it moves too quickly, that could choke off the economy. But usually as rates rise, that's actually a sign of demand for money. And so the economy is generally good. If rates are rising, the economy's got to be good to support that. And so the Fed's not going to keep raising rates into a declining economic environment and choke off the growth of the economy. So that'll only really happen if they really feel that the economy is taking off and the economy can support higher interest rates. We probably do need higher interest rates, but they have to wait until the economy can really support it. And as we said, there's so many really strange things that have gone on in this economy, the pandemic and the pandemic recovery, that it's hard really to tell exactly what the right path is. So I wouldn't want to be a member of the Fed right now having to figure this one out.
No, yeah, it's going to be a tough decision, and I agree. I mean, I think higher interest rates are overall very good. They get a kind of a bad reputation, if you will, on the street, because you think higher interest rates, they've been correlated with essentially being negative on the market, pushing the market down. But like Brian said, I think it's a great point. If the market is strong, maybe we'll see some short-term volatility, but it'll take that interest rate hike, and then it'll slowly move back upwards. It'll digest it and move upwards. And it's important that we get the rates higher. And I think overall the long-term stability and the long-term financial stability of the U.S. markets will appreciate it.
Yes. Well, and the other economic thing we've been a little concerned about is the national debt peaked over 30 trillion in the last week, Chris, and up from about 23 trillion just a short while ago.
Yep. Yeah. That was just before the pandemic struck. We're at 23 trillion. So we've added about 7 trillion since the pandemic, which is, it's absolutely crazy numbers we're talking about here. And I don't think I can't even conceptualize $30 trillion, but the fact that we've almost added a third of our national debt in the last 2 years is very concerning. And I think as we're easing out of hopefully this pandemic, I think that the politicians and need to take a stark look at this, and probably, the fiscally responsible thing would be to pay it down, but we never really know if the politicians really want to feel or be fiscally responsible, or whether they want to just give people more money, if you will.
We'll see. Well, so in what we see out there, Chris, you mentioned some new activity near the Salton Sea.
Yep. Yeah, so in California Salton Sea, 3 companies are looking at a to possibly mine lithium there, which is a huge resource for building electric vehicles and batteries. And it's very important, and obviously a lot of companies are trending in that direction. Currently, the U.S. imports nearly all of its lithium that we consume, so that would be very strategic and very helpful if we could find some mines in the U.S. to mine it, and not be entirely reliable on Australia, China, and some of these other countries.
Yes. Well, and then of course, with other changes, there's been a consolidation in the airline industry now again as well, right?
Yep, just out today, Frontier Group decided they're going to purchase Spirit Airlines, which is going to create a juggernaut in the discount airline space. But there's still some hurdles that probably we have to pass there. It's very preliminary, just was announced today. But we continue to see a consolidation in the airline space. So it's a continuation of a trend we've seen, but it'll be interesting. I mean, I'm sure it's going to get some pushback from the FTC and certain constituents like that.
Absolutely. Well, there's a couple of other interesting things. The Ferrari automobiles, increased their prices just due to input prices. So we saw a lot of inflation that was considered transitory because there was no inventory and there was more demand for certain goods, like cars, like autos, that kind of thing. Certain food prices went up as well, but that was much more of a demand push because there was less available. Now, because of the inflation in prices and input prices, we're seeing inflation due to input prices. So it's a supply side issue, and so prices are going up. So inflation was rumored to be transitory. It's clearly not. It may not be as strong as people think. Again, all the models that folks are looking at regarding inflation are based on other types of economies, not pandemic and then pandemic recovery. So again, we're not really sure how this is all going to play out. Maybe it will be transitory, but not right away. Transitory is 1 year. It's already been over a year or so, but maybe it'll slow down and not be as strong. Maybe we won't see galloping inflation and high interest rates just like in the 70s. So anyway, there's a lot to be thankful for in America, but there's a lot of confusion right now in the economy. But the good news, Chris, is the groundhog, well, maybe it's not good news for some, but some people like winter. The groundhog saw a shadow. So 6 more weeks of winter to March 15th to 20th in America. Around most of the country, the groundhog saw a shadow. And we talked earlier about how the market's been really sloppy. Technology stocks have been selling off, and not performing as well for a better part of the year, and then really a brutal January. And then some of the other elements of the markets look like pre-recession or pre-bear market activity, right? So should we absolutely assume that we're going to have a bear market and we're going to go into a recession? I don't think we should. The old adage that the markets have signaled 10 of the last 2 recessions. So in other words, we see the markets go down and then nothing negative happens in the economy. Maybe then the market needed a breather. Maybe the market was too extended. So that could be what we're seeing here. Anyone who was around for the 1987 market crash, no recession whatsoever, but the market went down 40% actually from top to bottom. And it turns out it was more of a computer crash than it was anything else. So we don't have to fear that necessarily. We'll see how things play out. Strong housing is still out there. There's a lot of pent-up demand for housing. So there's other elements of the economy. There's still really good, strong fundamentals. So Chris, I think that's all we can say at this point, isn't it?
Yeah, no, I agree. I think that, we don't know what's going to be coming down the road, but I think overall, there's certain areas that are positive and certain areas that are negative, which is any market. So we'll just take it as it comes, and I think there's a lot of things that play on the side of the U.S. economy.
Right, and for example, in November of 2007, when the economy started to show some weakness, and then into 2008, all those metrics that were all going down at the same time, that's not happening now either. So maybe this won't be a recessionary period of time. There was an old adage, and it's so old that I don't think Chris even knew about it, that if the NFC won the Super Bowl, that the market was going to be good, and if the AFC won the Super Bowl, well, that's way off out of the window. And who thought Tom Brady would lose? Now the Bengals are in the Super Bowl. And so it'd be an interesting Super Bowl. I'm not sure we can draw any indicators from who wins the Super Bowl, Chris, but maybe we could get a Ouija board out and we'll figure it out there. I don't know. But
there you go. Use some astrology symbols or something as well.
All right. Thanks everybody for being with us today on the 4-Star Podcast. And again, tell your friends about the 4-Star Podcast and make sure to give us a 5 out of 5. Thanks again, everybody. And we'll be back shortly with some very interesting interviews and also another market update in a couple of weeks. Thanks, everybody.